In cryptocurrency land, there's a lot of things that can make anyone go poor. And in today's video, I want to talk about one of the things that pretty much everyone uses as a metric for blockchain success and cryptocurrency success that in reality is making a lot of people lose a lot of money, and likely yourself and myself included. That metric in cryptocurrency is called total value locked, or rather TVL for short. And as I mentioned in the video title, in a lot of ways, this metric is making you poorer. And the first example of that is this month alone. Two Solana developer brothers admitted to pretending to be 11 different developers. And they jointly created dApps that accounted for over $7.5 billion in quote-unquote value. The catch is it was all fake and every single dollar was counted several times over. Just before we dive any deeper into the story of how total value locked is making you poor by paying attention to it, I want to mention that this video was written originally by Cardano Maladex, a DEX building on the Cardano blockchain. And if you want to check them out, all their links are going to be in the description, as they do provide more awesome information on Twitter and through their blog posts, along with the videos that I make covering their content because I think it is so good. Okay, now let's get back into why total value locked is making you poor. The event that's happened in the past month, where basically one or two people can heavily manipulate a total value locked valuation of any blockchain by billions and billions of dollars, has made a lot of investors think, if total value locked is manipulable, what other metrics that aren't really suitable for the evolving space of cryptocurrencies can be manipulated, and does TVL really have any value if it can be manipulated so easily? Especially when most investors, first thing they look at is total value locked for how valuable is this in the decentralized finance space or the DeFi space. Now looking back, how much merit does the metric actually have? And is it hindering your, actual downfalls of a protocol when it's counted tenfold over? Or is it actually real? Because in reality, this metric is meant to represent the total value locked in a protocol that cannot be easily liquidated or moved due to lockup conditions. But the higher this metric, the more trust, network effects, and positive momentum there is for a project. Or so the theory goes. In general, it's never going to be easy to evaluate digital assets, and tech corporations are difficult to price as growth is non-linear and direct costs are more or less fixed. And a lot of this happens with crypto too, and investors are left trying to create their own new metrics to estimate value. As we've learned in other eras, such as the .com era, the issue you see here is when startups or just people in general who are financially incentivized to use a certain metric for valuation can boost it, they're going to restructure to boost it as much as possible. Then the number or the metric just becomes unusable, and not only unusable, but dangerous and misleading to other new investors coming in who aren't so aware of what's going on. Total value locked is really an attempt to measure popularity and community commitments, the locked tokens in a system, and it makes sense to a certain extent. But since the same dollars can be folded into themselves and count as even more money, it gives a skewed picture of how much adoption there actually is, and TVL might even end up being used for a sign of inefficiency rather than efficiency. Imagine you have a protocol that has $1 billion in trading volume, but a total value locked of $100 billion. That is not efficient. It implies that 99% of the capital is underutilized. A high TVL without a high trading volume just might imply bloat and not really desirability. Also, something really important to note is that in traditional DEXs or decentralized exchanges where you lock your assets in a jointly owned smart contracts, you need large liquidity. Otherwise, minor withdrawals of any token cost a massive amount of slippage difference between the expected and final execution price, and this will heavily affect the people using the next level decentralized exchange that are being pushed onto them. Currently, with the most popular model DEXs used nowadays, the CFM-AMM model, it's unrealistic, and it doesn't only reflect market conditions well due to arbitrage adjusting its value to the actual market conditions. Basically, the spread of the total value locked is way larger than is realistic, and it's spread equally across a unrealistic point of view from the price of each token. Saying that a token has the same likelihood of going to $1 million worth versus $10 worth, and then spreading the TVL across that and just calling it a day. It doesn't really make sense in reality, and this does equate to a large inefficiency in total value locked and with DEXs that are now running. That brings us now to next generation DEXs, decentralized exchanges that aren't just based on a high TVL and trying to boost that metric to bring adoption to their own project that is inherently inefficient. In the future, when liquidity will be modeled efficiently and users don't need to pool their assets, the goal will be the opposite, a low TVL that serves a volume far higher than itself. This will be the era of hyper-efficient decentralized finance. TVL originally got popular because of all the DEXs that were building their first large-scale smart contract projects used this model. So their operational standards framed everyone's understanding nowadays of the rest of DeFi and the whole industry. That said, a lot of these early assumptions that have become increasingly outdated and incentivized are now unhealthy for the protocols. A perfect example of this is the recent Luna debacle. Basically, a high initial TVL increased its coin value, Luna, allowing its treasury to purchase a lot more Bitcoin, increasing its TVL and token value once again, and every TVL increase weakening the protocol overall, as people wondered how any of this was sustainable. Now, briefly, I want to talk about the blockchain that I'm invested in the most and comparing its low total value locked with other blockchains and why it's not really a poor investment just because of this, especially when using other relevant metrics. Many blockchains, including Cardano, are often mocked for having a low TVL, making it a poor investment for other people. At least that's what they think. But in general, this is ignoring the user experience. Are you going to place your money somewhere where it's locked for months, or always instantly available while still reaping the rewards? A good example would be suitcase logic. Basically, if you put $1 million into a $5 suitcase, the suitcase is still only worth $5 plus the million you have in it, or any money amount that you have in the suitcase. But if you want to increase the suitcase's value, basically what holds all the money in there, you have to increase people's demand for the suitcase, not just hope some millionaire is going to go ahead and place their entire net worth inside of it. In reality, we should probably not have a valuation metric based on Stockholm Syndrome, where a protocol is only valuable in direct proportion to how much value it can kidnap from its users. Not only is this capital inefficient, but it misaligns the desires of users and developers. Any blockchain in the cryptocurrency space is only going to survive if it has a community. And most crypto projects are open source. Projects live and die by the amount of adoption by said community and the network effects gained from its widespread use. Any honest metric should take into account value created for the users, not just the locked value that can be kidnapped from the users. In a lot of cases, the term total value locked isn't even as defined as you would think. Many people in many places, different publications of sorts, and different data aggregation sites use the locked value metric differently based on their own accord. And this in general just doesn't even make sense. We have to standardize what locking value means. A proposed solution from the Maledix team is that total value locked is an outdated AMM specific metric, basically the old DEXs, the last gen DEXs. We need metrics that measure intrinsic value. Only by measuring the intrinsic value can we estimate what the suitcase is really worth. An ideal next generation decentralized exchange should have low slippage, deep liquidity, especially around the spread, the current price, not just everywhere, every price direction, and evenly distributed to unrealistic places, but also high transaction volume, aka being popular. The chief factor being that we have to consider the utility that a protocol provides and how effectively it does that. All else is secondary and manipulatable, especially metrics like total value locked. It's not to say that we should never consider financial metrics, but the map is not the territory. In conclusion, total value locked is a metric that we invented to measure value in an evolving industry. However, as we saw in the case of the Solana brothers, TVL has failed to account for the complexity of crypto. So it's nonsense, and looking at it too much and depending on it is definitely making a lot of people lose a lot of money, aka making you poor. It's time to put total value locked back in the drawer and lock it in there for good. Again, I wanted to thank the team over at Maladex building their own decentralized exchange for writing this thread that this video is based off on, and I will leave all of their links down in the description, including the original thread. Thank you guys so much for watching. Stick with the Jack Stake Pool if you want to earn passive ADA on your ADA, and I'll see you guys in the next video.